The tax season brings the best creativity among all of us because we look for every possible option to reduce the tax liability. After all, it is our hard-earned money, and why let it go without a fight, right? So in this video, I will try to help you out by explaining a very important concept called tax loss harvesting. Before we move ahead, if you're new to this channel, go ahead and hit that subscribe button. We are building the most comprehensive library of videos for Indian investors and traders, and you will get so much to learn here. Alright, let's get into the topic. First thing first, I want to say that I'm not a chartered accountant. I'm just a regular investor who knows taxation based on research and my personal experience. So do consult with a qualified CA before implementing any steps that I'm going to recommend. Okay, so let me explain the concept of tax loss harvesting with an example. Let's say you're getting ready to file your taxes, so you summarized all your stock market activities for the year. And this is how it looks like. You are holding on to the shares of Titan, Sun Pharma and Tata Motors, and you have already booked short-term gains of 3 lakh rupees. So in this example, what is your capital gain or capital loss? Remember, while calculating the capital gains and losses, we only look at the realized portion, meaning that only those shares count that you have sold and no longer own. The ones that you are still holding on are called unrealized profits and losses, and they are not used in the calculation. So in this case, you are sitting on a realized profit of 3 lakh rupees. Therefore, the capital gains tax will be calculated on that. And since the short-term gains will be taxed at 15%, the tax would come to 45,000 rupees. Looks obvious, pretty straightforward, right? But wait a second. You are giving away your hard-earned money too easily. Let me tell you the technique of tax loss harvesting that will bring down your tax liability without affecting your portfolio. So our income tax department says that if you have incurred any short-term loss, you can use that to offset any profits you have made from either long-term or short-term profits. Now you have a short-term profit of 3 lakh rupees on which you are willing to pay a full 15% tax. Why not incur a short-term loss and bring down this profit? Sounds crazy, right? Why would anyone intentionally incur a loss? But stay with me for a minute and it will all make sense, I promise. So let's first incur a loss, meaning that we will sell shares of a stock where we have unrealized losses. Now there are 2 unrealized losses here, one from Sun Pharma and the other from Tata Motors. Which one should we choose? Now since we have to offset short-term gains, we have to incur a short-term loss, meaning that the shares that we have been holding for less than a year. Therefore, we will have to choose Tata Motors. Now go to your trading account, let's say Zerodha, from where you originally bought the shares of Tata Motors, and you place 2 orders, not 1, but 2. First, you place a sell order to sell those 100 shares of Tata Motors on NSE. At the same time, place a buy order to buy 100 shares of Tata Motors from BSE. And make sure that these orders are delivery or CNC orders and not intraday orders. Now some of you might be wondering that if you are doing some kind of an arbitrage. Absolutely not. What you have just done has saved you a lot of money. But some of you might be scratching their heads at what the heck is going on. So let's analyze what just happened. When you sold those 100 shares of Tata Motors, that unrealized loss of 2 lakh rupees became a realized loss of 2 lakh rupees, right? And what does that do to your tax liability? Let's calculate. You had a realized profit of 3 lakh rupees and now you have a realized loss of 2 lakh rupees from Tata Motors. So net your capital gains is 3 lakh rupees minus 2 lakh rupees, that is 1 lakh rupee. And your tax liability is 15% of 1 lakh, that is 15,000 rupees. So you see, you were willing to pay 45,000 rupees to the government and now you only have to pay 15,000 rupees. In this example, tax loss harvesting saved you 30,000 rupees. And as far as your portfolio is concerned, nothing has changed. You had 100 shares of Tata Motors earlier and you have the 100 shares of Tata Motors now. Absolutely nothing has changed. What we just did is called tax loss harvesting, meaning that booking a loss in the same financial year in order to bring down the tax liabilities. Does it make sense? I know it sounds a little tricky, but just watch the example one more time if you're confused and it will make sense. Now some of you might be thinking, is it legal? Absolutely. It's not only legal, it's very popular as well. Most of the big investors use this technique to reduce their tax liabilities every year. So while it is good to be patriotic and pay your taxes, it doesn't mean that you should be giving more taxes than you have to. Now the intention of this video was to take a very simple example in order to introduce the concept of tax loss harvesting. So don't get down to all the nitty-gritties. Try to get the big picture of how tax loss harvesting works. In real life, I know that there are lots of combinations possible. Therefore, it is best to consult with your chartered accountant before taking any steps. But I hope that you would be able to save some money using this simple and effective tax saving mechanism whenever it is applicable to you. If you have any questions, feel free to ask in the comment section below. And yes, if you're new, don't forget to subscribe.